afternoon, everybody. I'm going to talk about taxes as well. Thank you for this opportunity to share with you some words, some thoughts, some ideas that are under the discussion in Slovenia right now, where tax reforms are under preparation. I'm not going to talk about taxes in its complexity. I'm just going to pick some of the interesting topics in this field. I will say something about personal income tax, corporate income tax, value-added tax, and real estate tax, and also something about social contributions as a burden of wages, additional burden to wages. Let me first say something general about European Union aspects of taxation. The EU powers on this area, as we all know, are very limited. We can say partial harmonization rather than unification in this field. So we can talk here about the sovereignty of member states within the European Union, which is not absolute. There are some EU directives that harmonize not all the field of legislation, but some aspects of indirect taxation. The common concept as far as taxation is concerned in the European Union is smooth functioning of the internal market. The policy sets goals in the direction of combating harmful tax evasion, tax avoidance. Direct taxation is, we can easily say, not covered by EU binding regulation. What is sovereignty? Tax sovereignty would refer to the ability of member state, to authority of member state, to determine, to enforce their own taxes, tax system, tax policy, to set taxes, tax exemptions, deductions, to collect tax revenues. And let me say that tax competition and tax sovereignty are two interconnected concepts. There are various EU directives and regulations, but mostly oriented to prevent harmful tax practices, to prevent distortion of competition within the single market. The EU also encourages, as you see, as you know, sharing information in order to combat efficiently tax evasion, tax frauds, and so on. Let me move now to, this is the picture that shows with very different colors only one aspect of tax is corporate income tax in Europe, and it is a diversity of tax rates, probably also diversity of tax bases, but we have tax rates from 9% in Hungary to 30% in Germany. So this is really a competition, tax competition, which permits member states to impose a business-friendly environment with the tax policy. It is, yes, crucial for economy to have a stable and predictable environment. And for Slovenia, I must say, for recent 10 or 50 years, that it was not the case. It was not stable. various frequent uncoordinated tax reforms took place in the past. We have adjusted several times according to political interests related to this. There is a general common sense in Slovenia, and also proved by several research, like OECD research, and Chamber of Economy also is doing some research. I'm going to refer to these researches, but everybody says the same. Slovenia needs a tax reform, a comprehensive tax reform with the objective to harmonize its tax policy with standards and to ensure a sustainable revenue structures. And now I'm moving to the specific fields. Let me say something about personal income tax and social contributions in Slovenia right now. The basic issue is that the share of gross salary which is transferred to a bank is, in case of Slovenia, 66.3 of the gross salary. The average of OECD countries is 75.2. So, one more data, social security contributions in OECD average amount up to 26% of total tax revenue. And in Slovenia, it is almost 40% of tax revenue. That's, you can see at the first glance that the burden of taxes is very high, with taxes and, of course, social contribution, the burden of labor. You can see here other countries. Slovenia, as I said, 66.3, Austria 67, Italy 71, and so on and so on. USA 77.6 rests in the pockets or in the bank account. So tax burden of salaries is absolutely too high. Corporate income tax in Slovenia, it is average 90%. Already decision is made that it will increase in 2025 to 22%. And as you know, European Union average is 21.5. And here you can see the rates in other countries. Germany 30%, France 25%, Great Britain, and so on, so on. You can see also the countries that you are coming from here. So a diversity of different taxes. And Slovenian business community is urging to decrease the 90% tax. If we add here the deductions that are possible, then in Slovenia it is not 19 but 15%. And additionally, business community is requiring also to increase the reliefs for investments from 40% to 50%. And according to professional expertise and comparison, this is not acceptable. But there is an important and interesting, let me say, idea which circulates now as far as corporate tax is concerned, namely a progressive taxation of profit. It's maybe a little shocking for somebody, but progressive would mean not just depending on the size of the profit, but depending also of the relationship between the amount paid for profits and amount paid for labor costs. So this is one of the concepts which would be interesting to to discuss what are the consequences, because this concept is following a certain consequences here. The next issue is VAT. OECD study from 2018 says that there is a range of goods and services which are taxed at reduced VAT tax, which benefit to households, to wealthier, to more rich households. And it could be, so there is a room for compensations here. If this tax base were, so the normal tax, VAT tax, which is 22%, should stay like it is, but the lower rate of VAT, which is 9.5, is applied in too many goods and services. And as I said, it should be reduced because if on these fields related to these products and services which benefit more to rich than to the poor. One of the main issues of Slovenia is low taxation of real estate. So I'm saying a few words on real estate tax. You see these numbers. Average property tax in EU is 1.8 of GDP. In France, it is the highest rate at 4%. Slovenian rate of real estate tax is at the level of 0.6% of GDP. So this is a very, it's uncomparable, we can say, very low. There is a room in introducing real estate tax for cutting down social contributions and also for cutting down labor personal income tax. These are also the suggestions of OECD study. Let me say a few words on some specific proposals, which is so-called. These proposals are from business community, Chamber of Economy, and one of them is so-called development cap. I don't know if you have met this term. That means there is a limitation of social contributions at a certain level of gross salary. For instance, 4,400, which is 2 times of average, or 5,500, which is 2.5 times of average salary. This proposal addresses middle class. It addresses brain drain of high educated people with specific knowledge, and it addresses also multinational companies not to move their headquarters in the neighborhood countries because of not favorable wage burden. So this is also an interesting proposal. And another one, tax incentive encouraging employee ownership, aiming to simplify participation of employees in companies' profit or in companies' ownership, in shares or options or cash scheme. So tax facilitation of employee participation in profits. The explanation is that this way companies can increase the loyalty of the employees, focus on long-term strategy, ensure higher growth, and so on and so on. It is also the proposal of business community. And one more, it relates. Okay, let me summarize the 10 proposals which are now circulating in the reform. The first proposal is to eliminate the top income tax class, which is now in Slovenia 50%, to reduce it to 45% as a maximum, except for minimal salaries. And then the second proposal is increase by 1% tax rate for second and third class. You have here the numbers. And the third, very important, reduction of social security contributions for employees, and this would be compensated by corrections of VAT and real estate taxes. The fifth proposal is reduced VAT rates, and in some fields, in some products and services would be abolished. As I said, where benefits more to the rich. Then introduction of real estate tax to the amount that would be average of OECD countries. And that would compensate the reductions of social security contributions. And as I said already, development cap, limit to all social contributions above a certain amount of salary. Tax incentive for employees. And I haven't mentioned so far, let me just say the proposal, increase the tax deduction for pension savings. From now, it is 2,600 to 5,000. That is from 5.9% of gross salary to 10% of gross salary. And the 10th proposal, and I'm going to conclude with this, to consider progressive taxation of companies' profit, which is maybe for somebody a revolutionary approach, but there are interesting arguments for this. Let me just say, because it was already a presentation referring to real estate, that our proposal is absolutely progressive taxation of real estate tax as well. That's it. It's quite a demanding reform. When I say demanding, politically demanding. And it's up to the courage of politicians if this reform will be introduced or not. Thank you very much.